took less than 30 seconds. One click. One number typed into the wrong box. And by the time anyone noticed, a company had already lost hundreds of millions of dollars and set off a chain reaction that would end up costing far more than that. No bomb went off. No market crashed on its own. Person just pressed enter. And that's the part that should scare you, because it means this could happen to anyone, including you, just on a smaller scale. Here's the strange part almost nobody knows. The mistake wasn't made by a rookie. It wasn't made by someone reckless. It was made by an experienced trader at one of the largest financial institutions on earth, doing a routine job he had done 100 times before. And that's exactly why it slipped through. We'll come back to that. Before we go further, if stories like this fascinate you, the kind where one tiny decision changes everything, hit like right now, subscribe, and tap the bell so you don't miss what happens when the world's fastest markets meet ordinary human error. Because this isn't just a story about a bad trade. It's a story about how fragile even the most sophisticated systems really are. Now picture Tokyo, December 8, 2005. The Tokyo Stock Exchange. A freshly listed company called JCOM Co., a small recruitment and staffing firm, was making its public debut. Its very first day trading on the market. A trader at Mizuho Securities, one of Japan's largest financial firms, had a simple task. Sell one share of JCOM stock for 610,000 yen. That's roughly $6,000 at the time. A normal, routine transaction for a debut listing. But he typed the order backwards. Instead of selling one share for 610,000 yen, the order that went out was to sell 610,000 shares for 1 yen each. Read that again. 610,000 shares. At 1 yen. When the company had only issued about 14,500 shares in total. Imagine being that trader. You've done this job for years. Your hands move fast because they have to. Markets don't wait. And in the time it takes to glance at your screen and hit confirm, you've just tried to sell 40 times more shares than the entire company had ever issued, for next to nothing. The Tokyo Stock Exchange's own systems were supposed to catch something like this. There were supposed to be safeguards. But the exchange's software had bugs of its own, and when Mizuho tried to cancel the order within minutes of realizing the mistake, the system rejected the cancellation. Not once. Multiple times. That's the twist almost nobody expects. It wasn't just human error. It was human error meeting a broken safety net at the exact same moment. So the order sat there. Live. Executable. And the market, doing exactly what markets do, reacted instantly. Other traders and algorithms saw an enormous number of shares suddenly available at rock-bottom prices, and they started buying. Fast. By the time Mizuho finally managed to get the trade stopped, the damage was done. The firm ended up buying back shares at wildly inflated prices to cover a position it never should have created, absorbing a loss estimated at around 40 billion yen, roughly $340 million at the time. That number alone is staggering. But it's not actually the biggest number in this story. Here's what almost nobody talks about. When news of the error spread, investors didn't just see one bad trade. They saw a crack in the system. If the largest brokerage in Japan could make a mistake this basic, and if the exchange itself couldn't stop it in time, what did that say about the safety of the entire market? Confidence is fragile. And once it cracks, it doesn't stay contained. In the days that followed, Mizuho's parent company saw its market value fall by well over $2 billion, as investors reacted not just to the loss itself, but to what it revealed. The trust that makes markets function, the assumption that the system has guardrails, had been shaken. And shaken trust is expensive in ways that never show up on a single day's balance sheet. So let's ask the real question. How does one 30-second decision spiral into a $2 billion wound? This is where psychology matters more than finance. Under pressure, our brains don't slow down and double-check. They speed up and default to habit. Psychologists call this automaticity. The more times you've done a task, the less consciously you process each step, because your brain is trying to save energy. That's efficient right up until the one time it isn't. The trader wasn't careless. He was human, running on autopilot in a job where autopilot is usually the only way to keep up. And once the mistake was live, a second bias took over: loss aversion. The fear of a small loss becoming a bigger one pushes people, and firms into panic decisions, trying to undo damage fast, sometimes making the situation worse in the rush to fix it. Mizuho didn't have 30 seconds to think calmly. They had 30 seconds to react. And reacting under fear rarely produces your best decision-making. This is the same psychological trap that shows up in your own financial life, just at a smaller scale. The panic sell during a market dip. The rushed decision to move your money because a headline scared you. The trade made in seconds that took months of savings to build. Different size, same wiring. If this kind of story makes you think differently about how fast decisions can undo years of careful work, drop a comment and tell us. Have you ever made a financial decision in the heat of the moment that you later regretted? You are not alone, and understanding why it happens is the first step to avoiding it again. Now here's the deeper lesson, the one that actually matters long after you forget the name Mizuho. This event became one of the most cited case studies in financial risk management. Not because the mistake was unusual, human error happens constantly, but because of what it exposed. The problem was never just one trader. The problem was a system with no reliable second layer of protection. No hard stop that automatically blocks an order that obviously makes no sense. No pause button strong enough to catch a number that was physically impossible, since you cannot sell more shares than exist. Good risk management isn't about assuming humans won't make mistakes. It's about assuming they will, and building systems that catch those mistakes before they become catastrophes. Every well-run investment portfolio, every disciplined trading firm, every smart personal budget works the same way. Not by relying on perfect willpower or perfect judgment in the moment, but by putting guardrails in place ahead of time, back when your mind is calm and thinking clearly, not scrambling under pressure. That's the real opportunity cost hiding inside this story. Mizuho didn't just lose money on one trade. They lost the years of trust and market value that took decades to build, because a safeguard that should have existed didn't. After this event, and other similar incidents around the world, exchanges began installing tougher automated circuit breakers, tighter order size limits, and mandatory confirmation steps for unusually large trades. The financial world quite literally rebuilt parts of its infrastructure because one trader typed the wrong numbers into the wrong boxes, 30 seconds too fast. And that lesson didn't stay in Tokyo. It applies just as much today, in an age where trading happens in microseconds through algorithms, and where individual investors can move their entire life savings with a single tap on a phone. The tools have gotten faster. Human psychology hasn't changed at all. So if there's one thing worth carrying with you from this story, it's this. The size of a mistake is rarely about how much time you spent making the decision. It's about how much protection you built before you ever had to make it. If this story changed how you think about risk, share it with someone who needs to hear it. Maybe someone about to make a big financial decision without a safety net of their own. Because somewhere, right now, someone is one rushed decision away from their own 30 seconds. The only real question is whether they've built something in place to stop it before it happens, and whether you have too. Subscribe to Money Elevate for the stories the financial world doesn't want you to forget.